Alright guys, warm welcome to another week ahead video. This week's video will cover the trading week running from Monday the 14th of June to Friday the 18th of June. Our focus this week will be firmly fixed on the upcoming FOMC meeting. It's bound to be a very interesting one where Fed Powell has some explaining to do on a couple of different fronts. Markets are of course not expecting any changes to the federal funds rate or any changes to the quantitative easing program, and it should be no surprise that they will try as hard as possible to signal a very patient stance on things like rates and tapering going forward. Now, the main focus points that we'll be focusing on in this meeting will be firstly the updated summary of economic projections, secondly potential changes to try and alleviate money market concerns, and number three, the finally talking about tapering. Now, if we take a look at the summary of economic projections, remember the last time round we got this was back in March. So we are going to see a little bit of economic projection upgrades for the bank. It will be very interesting to see how some of these numbers changed. Quite interesting when looking at the projections for headline PCE. That was expected at 2.4%. Core PCE was expected at 2.2% last time around. Now, with this week's May headline CPI printing at 5% and core CPI printing at almost 4% at 3.8%, you know, Fed Powell has some explaining to do on the inflation front. These prints won't, of course, change their transitory view on inflation right now, but just dismissing it this time around as purely being base effects and bottlenecks, it would be quite a stretch from Fed Chair Powell. So it will be interesting to see whether we might have a potential slight rhetoric change, taking a more balanced view on some of these rising inflationary pressures that we've seen. Now, even though these numbers are high, these CPI numbers we've had recently, inflation is a very prickly subject right now. There's lots of caveats that we need to consider. So the bank's probably going to look to try and focus more on the employment side of the economy, stressing that it's going to take some time for that substantial progress to be achieved, you know, in order for them to actually start thinking about tapering. And they will most likely use those two recent softer than expected NFP prints to justify that ongoing dovish view. The more than 7 million post-pandemic gap in employment is and obviously should be a concern for the bank. Now, even though that is the case, recent labor data has shown signs of being slightly tighter than the NFP report suggested. If we take a look at the recent US JOLTS report, that showed the highest number on record of job openings at 9.3 million. And the same report also showed 4 million people voluntarily left their jobs in April, and that continues to show that the jobs are there right now, but workers are confident that conditions are right for them to actually go and find another job at possibly even higher wages. So it will be interesting to see what Fed Chair Powell has to say about these types of data points. However, it is very likely that we will see a move to the upside in the unemployment rate projections based on that softer than expected April as well as May job sprints that we had. So coming back to inflation for a second, based on these recent data points that we've had, the markets are expecting an upgrade to the headline PCE and core PCE metrics. Not expecting a massive jump from these two, but will be interesting to see how far they stretch that expectations. But they're most likely to keep those 2022 numbers very close to prior, to basically show the markets their commitment to that transitory view on inflation right now. The market's also expecting a sizable upgrade to the growth expectations for 2021, probably looking something in the vicinity of 7%. That will also be in line with recent comments we've had from Vice Chair Clarida, who noted that 7% growth is definitely possible this year. Now, apart from the economic updates, the biggest focus for the updated economic projections will probably be the infamous dot plot. Now, at the March meeting, only 7 of the 18 members forecasted a rate hike by 2023. So there's going to be a lot of attention to see how some of these dots have shifted. It would take just 3 more members to basically have a change of heart for the median dot plot to show a potential hike for 2023. Now, right now, markets are really torn on this one. Some have suggested that if you just take a look at the recent communication from even the dovish members, that it won't be really that difficult to find 3 more slightly more optimistic members to basically have that shift in that median dot plot. But those that don't really see this happening says that right now they think Fed Chair Powell should have good support on this front, and that the bulk of the members would probably want to err on the side of caution right now and keep their dot plots to reflect no expected rate hikes by 2023, just given the massive volatility we've seen in some of these recent data points. Now, the other interesting one for this meeting is whether we see any action by the bank due to some of the stuff we've seen happening in the money markets. Now, recently we've seen a huge influx in cash into the Fed's reserve repo facility. Now, that's happening due to the ongoing quantitative easing purchases. We've also seen the Treasury basically drawing down that general account at the Fed, and they're doing that in anticipation of that reinstating of the debt ceiling that's going to happen at the end of July. That's very fast approaching. So all of these factors have basically been pushing a massive amount of cash into that Fed reserve repo facility. Now, even though this has caused some stress for participants, it is important to note that right now the facility has so far really just been doing exactly what it has been intended for, basically as a parking lot for massive amounts of excess liquidity. But given the sheer size of the money that's currently parked at the facility, it has seen some stress developing in money market rates, especially at the front end, where we have seen some rates being pressured down to zero, and some have actually briefly dipped into negative territory. Now, for some participants, this hasn't really been a concern at all, and says that the Fed shouldn't be concerned with this either, because the facility is doing exactly what it is intended to. And if you take a look at the federal funds rate, it hasn't really budged. It's sitting very close to 6 basis points. So that is important to keep in mind. But some other participants also do argue that the size of this repo facility usage right now, currently sitting close to 600 billion, is becoming a little bit of a challenge, and the bank could be forced to hike the interest on excess reserves, the IOER, by about 5 or 10 basis points, or potentially hike the yields on that repo facility as well. Now, the biggest risk to such a move in a meeting like this would be that the markets take it as a potential hawkish tilt by the bank, when it would really just be nothing more than a technical adjustment. And if the bank takes a more balanced view on the recent surprises in CPI, and if we see a possible lift in that 2023 dot plot, if we then see a hike in some of these rates, that could see the markets interpret this as a more hawkish tilt, as a more hawkish meeting. And that's something that the Fed will probably want to avoid. So it will be very important for them to really stress and frame it correctly as a technical adjustment, because if we do see that happening on the back of other positive things, it could have more of a hawkish tilt. Now, apart from all of that, the markets will also be focused on any tapering comments from the bank. After the April Fed meeting minutes, as well as the recent comments from various FOMC members, Fed Chair Powell won't be able this time around to just deny that they haven't been talking about tapering, because we know that they have. Yes, of course, the official tapering debate hasn't started yet, but at the April press conference, when he was asked whether they have been talking about tapering, he made it very clear that they actually didn't. And yet, of course, the April minutes revealed a very different picture. Now, to keep up with the overall dovish tone despite this, Fed Chair Powell will likely say that the fact that some members have been talking about it doesn't mean that the FOMC has started the official tapering debate, and that is of course something that we already know. And he could likely also state that the time to talk about tapering has not yet arrived, but if the economy continues to improve, then the debate will likely start in the coming months. So he might be signaling, giving a little bit of a smaller signal there compared to that prior meeting, just because, he has some explaining to do after he expressly said that they haven't been talking about it, and then the minutes show that, oh, actually, they have been talking about it. Now, after the April Fed meeting minutes, we've also had various other Fed officials. We've had Clarida, Williams, Qualls, Brainard, apart, of course, from the obvious hawk like Kaplan. They have slightly shifted their rhetoric recently as well, and they have become more open to the idea of at least beginning tapering discussions at the upcoming meeting. So on this front, it'll be very, very interesting to see how Fed Chair Powell frames the tapering discussions that we know they have been having. And even though announcing that the tapering discussions have officially started is not expected until we get to Jackson Hole Symposium, the official debate, one has to argue that we are further away from not tapering than we were just a few short weeks ago. And the closer and closer we get to Jackson Hole, the more the market's anticipation of tapering, in our opinion, will start to increase. And this means that apart from things like the central bank meetings, the incoming data points will be very, very important as a gauge for how fast or how slow the market's expectations of tapering will unfold. Now, in terms of a trading plan for the week ahead, guys, on Friday, we did see quite an interesting move to the upside in the US dollar. There wasn't any real fundamental news flow behind this move. Some analysts were pointing to some chunky option expiries. Others were pointing to the possible beat that we had in the University of Michigan sentiment survey. In our opinion, though, the most likely reason could be much simpler than that. You know, short positioning for the dollar has been on the rise again over the last couple of weeks. So given the proximity to next week's FOMC and given some of the recent comments we've had from Fed members, etc., it could just be some position squaring going into Wednesday. And if it is position squaring, if that is the case, then we could be in store for more of that running into the meeting. So that is definitely something that we just want to keep in mind heading into that FOMC meeting on Wednesday. So turning back to the potential bullish and bearish outcomes, it's going to be very simple. In terms of that interest on excess reserves or RRP facility, like we said, if they do make that move, if they do hike it, they are likely going to frame it for what it is, just a purely technical adjustment. So if we do see that hike taking place, and if we don't see that hike taking place, that's not something that we expect to be a real game changer. But of course, you know, given the other hawkish or given the other dovish possible outcomes, it could have more of an impact. But just keep in mind, we're not expecting a whole lot from that potential hike or no change from the Fed in terms of that policy as well. In terms of the other bullish outcomes, we're looking for much bigger than expected economic upgrades. We're expecting that obviously to be positive for US 10-year yields, positive for the dollar, negative for things like euro dollar. If we do see the Fed taking a more balanced view on inflation pressures, that will also be more positive. What we mean by that is, as we explained, you know, previously the rising prices was just dismissed as base effects, as bottlenecks. But if we see them taking a little bit more of a balanced approach after these big moves we've seen recently, that'll also be seen as a more of a hawkish, more of a bullish outcome. The third one there, if we see the dot plot median projecting a first hike expected now in 2023, that's also expected to be more positive for the dollar, for yields. And then the fourth one, if we see them giving signals that the official tapering debate is closer than previously expected, that's also expected to see more of a bullish move. In terms of the bearish outcomes, it's really just the exact opposite. Lower than expected economic upgrades, especially on the inflation front, will be very interesting to see how that plays out. Then if they dismiss once again the recent CPI surprises and just affirms that transitory view, again just says, you know what, it's base effects, it's bottlenecks, we're not paying any attention to this, expected that to be more negative for yields and the dollar. Thirdly there, if the dot plot stays to show no hikes in 2023, also expected to be more negative. And then if they push back against any type of tapering discussion hopes, once again expected that to see more negative for yields and negative for the US dollar. Guys, do remember that the potential outcomes and the potential market reactions in this report is merely a guide for what we would expect in the event of the various outcomes, and that the markets can always surprise in the way that it reacts. So this is never intended as a trade call, but rather just intended as a framework for you to use in your own scenario planning.